What's the 60% rule and how does it work to mitigate Spanish wealth tax? My name is Patrick McDonald and this is financespain.com. As we know, wealth tax in Spain can be quite punitive, but there are legitimate methods to mitigate it. One such method is the 60% rule. So how can we take advantage of this? Well, Spanish law dictates that your wealth tax and personal income tax liability combined cannot be more than 60% of your overall taxable income base. In fact, using this method can actually reduce your wealth tax bill by up to 80% in the most optimum of circumstances. So let's take a basic example to illustrate how it works. Our client, Mr. Smith, is a resident of Spain. He holds a direct portfolio of stocks and shares worth 4 million euros via a private bank in Hong Kong. So minus his 700,000 allowance, Mr. Smith has 3.3 million euros exposed to Spanish wealth tax. At an average of 2%, that would mean paying 66,000 euros every year. Not very nice. Now, if Mr. Smith made no changes, the 60% rule may not work for him. Why? Well, let's presume the 4 million that he holds in that private bank portfolio makes an average gain of conservatively 5% per annum. That's 200,000 euros, which would generate a savings or capital gains tax bill of approximately 45,000 euros each year. So his wealth tax plus the tax on his capital gain would result in an overall liability of approximately 111,000 euros payable every year to a very happy Spanish taxman. But could he take advantage of the 60% rule to reduce this tax? Remember, your wealth tax and personal income tax liability cannot be more than 60% of your overall taxable income base. The taxable income base in this example is 200,000 euros, the growth that his stocks and shares have made. So 60% of 200,000 is 120,000, so therefore Mr. Smith has no reduction because his joint tax liability of 111,000 is less than that 120,000, leaving him not in very fine fettle at all. So Mr. Smith comes to us and asks us, is there anything that we can do to help? And thus the tax mitigation cavalry come riding over the hill. We take his investments with a few required adjustments and wrap them in a Spanish compliant portfolio bond. Now the 60% rule would work like this. Although his 4 million investment portfolio still makes 5% gain, there is zero tax exposure whilst his assets remain wrapped in the Spanish compliant bond. Therefore, he has a taxable base effectively of zero, and 60% of nothing is, well, you know. So in theory, that should lead to zero wealth tax, but the law does stipulate that a minimum of 20% must always be paid. So in this case, Mr. Smith would have a wealth tax bill of 20% of 66,000, which is 13,200, a saving of 52,800 euros or 80% on his wealth tax every year. Not to mention the fact that he's also no longer paying 23% capital gains or savings tax every year, whilst his assets remain within the wrapper. Added to that, he'll benefit from proportional tax relief on any future income withdrawals, making him a much happier client. If you're watching because you have concerns about Spanish wealth tax, then hopefully the video has been of some use to you, and please do give us a call if you'd like more information specific to your own situation. In the next video we'll talk more about Spanish compliant portfolio bonds, but for now, it's bye from me.